Hey guys, Seeney here and welcome to another episode on the Australian Wealth Channel. Now today, we are going to be talking about the pros and cons of stock market investing. Okay, so I'm a really big fan of the stock market. The stock market has generated great returns for myself and a lot of people that I know for investing in a number of different companies. And there's so many examples of companies that have grown massively this year that we're going to get to, and why the stock market can be both an incredible investing asset class and also a very difficult one which can lead to a lot of downsides. So we're going to explore both sides of the stock market today. So before we start, make sure you like and subscribe to the channel. Helps to get these videos out to more people so they can learn a little bit more about investing and business and any topics to do with finance. So we're going to start with the pros of stock market investing. Now, one of the biggest pros of the stock market is that it is fast. Now, what I mean by that is that you can get in and out of stocks within fractions of a second. Now, this can be really important. Let's say that a company comes out with incredibly bad news and it's not going to be great for the company at all. They're going to lose a lot of money from whatever it is. It's very easy for you to get out. And let's say that a company announces great news and they're going to be incredibly profitable in the future, then it's really easy to get in. A lot of stock market investing, I think, has to do with timing and finding the right company at the right price. You know, there's a lot of debate about, time in the market versus timing the market. I think both of those things are really important. Obviously you should be continuing to invest over time, but if an opportunity turns up that is very attractive, then it can be quite time sensitive to jump onto that opportunity. So stocks are fast in comparison to real estate, where it can take weeks, months, even years sometime to find a buyer and have the property settled. So I think for a lot of people, the speed is a very attractive thing about the stock market. Another one of the pros of the stock market is it has had the best returns out of any asset class across the entire world. So if you're investing in an index fund, then the returns that you're going to get from that over time are probably going to be better than any other asset class. Now, obviously, with real estate, you have the advantage of using leverage a lot safer, which means you may potentially be able to earn more money in real estate. But if you just want to use your cash that's yours, the best returns are likely to come from the stock market. Not always, but likely. One of the things that I really love about the stock market is the ability to diversify. So when you buy a house, you're basically stuck with that house in the one location, and the capital growth is kind of stuck to whatever that region's going to do. Whereas with stocks, it's so easy to diversify. You can put a little bit of money over here in computers, you can put a little bit of money in defense. Like, there's a lot of different places that you can park your money if you think a sector is going to do really well. So the ability to diversify like this can lead to pretty safe investment results. Now, obviously, the more you diversify, the less returns you're probably going to get if you pick the right companies. But at the same time, you're less likely to lose money as well. And I think for the long term, that's really important. If you're putting 100% YOLO call options on Tesla, hey, you might make a lot of money, but you might also lose a lot of money. But if you can diversify amongst a heap of different stocks, then it can be actually quite a safe investment. And I think one of the most attractive things about the stock market is it's really easy to get started with only a small amount of money. Whereas with real estate, if you want to get a property in Sydney, you're looking at over $1 million. You have to put a significant down payment down, over $100,000 to get a property like that. Whereas with stocks, you can invest from as little as like 10, 20, 50 bucks, which I think is really attractive for a lot of people that really just want to get started and start to grow their wealth into something bigger over time. There's a much lower barrier of entry, which I think is fantastic. So if you pick the right stocks, you can generate insane returns. There's so many examples, especially this year, if you bought at the March lows, of companies going up 100, 200, 700% or more. So, let's say you invest like $10,000 and you're getting a 700% return. Then that's starting to turn into a very nice chunk of change. So yes, the returns can be quite large. But of course, with every asset class, it's not always roses. We also need to talk about some of the cons of stock market investing. Now, the first one, and I think this is the most challenging one for a lot of people, is that the stock market is highly volatile. One day you might be up 20%, the next day you might be down 20%. Things can move incredibly fast. So for a lot of people that are especially new to investing, they might see their stock go down 10% and they just cut it. They're like, oh no, I just don't want to lose any more money. But the next day it might jump up to 10% and you're back to zero. And you've actually lost money when, if you're holding, you might have actually gained money. Now, of course, this can continue. It might be minus 10% to start with, it might go down to minus 20. But I firmly believe if you're doing the right research into the company and that you have great confidence and you completely understand where the company is going, then you should be happy to be buying more shares at a lower price. But of course, a lot of people don't invest this way. They kind of just throw darts at the wall and hope that something sticks. So of course, the stock market is highly volatile. So if you don't have a strong stomach, then it might not be the best asset class for you. Now, one of the other cons with the stock market is that if you are using leverage, you can get completely wiped out. There's so many people that trade on margin and end up losing a lot of money. So borrowing money to invest in real estate is generally a good idea. Borrowing money to invest in stocks, I do not think is a good idea. I know that Warren Buffett firmly believes that you don't need leverage to be very successful in the stock market. And leverage can completely wipe you out, even if you are right. Like, take a look at the case of Tesla. So let's say that you bought in when Tesla was $400 a share. Now, the stock price of Tesla went all the way down to 180. And let's say that you went 2 to 1. You just, you invested $10,000, you borrowed $10,000. That would have wiped you out. You would have lost literally all of your money on a margin call. And then you would have missed out on the absolute monster gain that Tesla has had over the last few months. So with margin, even if you are right in the long term, you can get completely wiped out and lose your money. So it's not a very safe way of using leverage. So you need to be really careful about how you do that. And it's very attractive because using leverage is quite easy, which makes it, in my opinion, quite a massive con for most people. Now, the next con of the stock market is the tax benefits are nowhere near as good as real estate. Now, in terms of taxation, the most common form of taxation within the stock market is, of course, capital gains tax. Now, you also have dividends. We can save them for another time. With capital gains, about 50% of your gain is taxed if you hold it for less than a year in Australia. If you hold it for over a year, that capital gains tax is reduced to 25%. So let's say that you invest $10,000 and you get really lucky on a stock and you manage to make $2,000. You make a 20% return and you decide that you want to cash out. If you do that within 1 year, then the government is going to add an extra $1,000 onto your taxable income. If you do it after a year, you hold a stock longer than a year, then the government is going to tax that at 25% of your gain, which means that you're going to be taxed $500 on top of your taxable income. There's no real tax benefits to holding stocks. That's the only one that I can really think of at this point. So if you are looking for tax benefits, real estate is a much more effective way to go on top of stocks. Now, one of the other cons with the stock market is that you have no control over your investments. Now, what this means is that, your company that you're invested in might report numbers and they might be awful. And that has pretty much nothing to do with you. It's not something that you can control. You're basically just speculating that the company is going to do well in the future. Whereas with real estate, you can choose exactly the area that you want to invest, what you want to do with the house, what tenants you want to put in the house, all different kinds of things. Whereas with the stock market, obviously you have a massive choice of companies, but you cannot control what that company does. Like, let's say that you have a great idea of how you want Amazon to run. If you actually want to implement that into Amazon, then you're going to have to buy a lot of shares. Like, you're going to have to buy like 51% of the company to get that forced through. And who's got that kind of money? Like, it's over 500 or plus now. You'd have to be putting over $500 billion into that stock so that you could have the final say on how that company's run. So you're kind of at the whims of the company. Now, the other con with the stock market is that it is full of pros and computers. Now, what I mean by that is that there's people that invest in the stock market that dedicate their entire lives to getting the best possible return. And there's people that develop computer programs and AI programs, algorithms that dedicate their entire lives to getting these computers to get the best returns. So that's really what you're competing against. And the reason that 90% of traders lose money if they're just doing like day trading in the stock market is because they're competing against these things which know exactly what they're going to do before they even do it. So over a very long period of time, you're basically guaranteed to make money, but focus on a very long period of time. If you're day trading, it's very hard to make money, regardless of what people say on the internet. Sometimes you can get away with a win here and there, but of course, over time, a lot of these people end up losing money. So if you are investing in the stock market, it is much smarter to take a long-term investing approach and forget about the day-to-day movements. Because unless you're some kind of super genius, and even then, you're competing against computers, which are infinitely smarter at that particular field than most humans. And of course, the final con is that you might have picked the right stock, but you might have picked the wrong time. Now, of course, time in the market is really important. It's important to start investing as early as you can to get the best returns. But of course, there are windows of time that do open up where you might get an opportunity to get a particular company at a fantastic price. There's so many examples of this over the past few years, whereas I rode Apple twice, from 140 all the way up to 220. And at that point, I thought that's a pretty fair valuation. I'm happy to sell out at that point. And then lo and behold, it wasn't too much later that Apple dropped again all the way down to 140. So I saw that as an opportunity and went, okay, I'm gonna buy that. And then I managed to ride it all the way up to 220 again. So there is an element of getting the timing right. Because if I said, okay, well, you know, Apple looks decent at 190, I'll buy it there. And I buy it, you know, I might get a little bit of a gain, and then I sell out, which I probably wouldn't. But of course, then it dips down and you haven't got the money to invest at that particular time, then you can actually lose out on a lot of potential gains. So it's important to be continuously investing, but when opportunities do appear, you need to make sure the timing's right. And for most people, this can be quite difficult. So I hope you found this video interesting. Thank you so much for watching. Make sure you like and subscribe to the channel. It helps to get these videos out to more people. So my name is Seeney, and we'll see you later.